U.S. Federal Reserve cut interest rates by 25 basis points for the second time in a row. Policymakers, however, remain divided over the future course of action. To see how the markets are reading into this, let's welcome in JPMorgan's Luis Oganes, who is speaking to us on the sidelines of their India Investor Summit. Thanks very much for taking out the time, Luis. Appreciate it. What have you guys made out of the rate cut? That was unanticipated lines. But the fact that, the future course of action and the outlook, was fairly divided.
Well, this was actually pretty much in line with what we were expecting. We expected a cut, but we expected the language around it not to be too promising in terms of what comes next. A lot of talk about data dependency, etc. We're not expecting the dots to be altered. So in a way, this still falls within what we have in our forecast, which is a cut last night and two more cuts in the two remaining FOMCs. We think that probably the macro indicators will justify further action by the Fed in the coming months.
Luis, central banks have been, over these last few months, have been making sure that there's enough liquidity in the system. The outlook remains dovish. Obviously, now the commentary changes a bit around. But do you think that on a global scale, all central banks now that they push for liquidity, they're pushing for liquidity, it's actually not all that bad with regards to even this translating into a meaningful growth number?
Well, the reality is that the macro indicators show that the entire world is decelerating. So the fact that the Fed is cutting rates, and not only the Fed, right? Other G3 central banks are doing so as well, ECB, BOJ, is really providing a window of opportunity for EM central banks to cut rates around the world. This, in principle, should be a welcome development to the extent that in emerging markets, we're not seeing at this stage, again, a recession, and the fact that EM central banks have room to cut, that should at least provide some floor to growth. And let's hope that growth stabilizes and doesn't fall further. But this is something obviously to watch. And monetary policy is the only game in town these days. Very few countries have really space to do something on the fiscal side. So that's why we see it as something positive given the circumstances for EM central banks to have the window to cut because the Fed is cutting.
And that's probably most likely with the RBI as well, as we meet in October and they discuss their rate decisions. But Luis, just coming back to the emerging market pack, at this current point in time, with China opening up its markets to investors, do you feel that this could be a slight bit of a setback for money that was probably set aside for a market like India?
Well, certainly the fact that you're seeing so many, a large share, more than 40% of government bonds around the world trading at negative yields these days, and that share can only increase given that there's more central bank cuts. There is money still coming to EM fixed income markets, EM bond markets. That is why China, in a way, has decided to do things, take steps to have China incorporated into global bond indices, and that secures some steady flow of money coming to their domestic bond markets. I think that in India, obviously, there's been institutional resistance to open the door too much to foreign money, and this is why, even though yields are coming down everywhere around the world, you're still seeing them being quite sticky here in India. Probably this is a good time to reconsider that policy, and to the extent that you want to smooth the path of fiscal adjustment, maybe allowing foreigners to help you finance this transition may not be a bad thing.
What about the equity markets then? I mean, where do you stack India in terms of preference?
Well, we have if you look at our forecast for growth for this fiscal year, we have 6.4%. And given the low results in the first quarter, what we're expecting in general is some modest cyclical rebound in the coming quarters, partly helped by RBI cuts. We are expecting around 25 basis points in October and maybe more to come afterwards. And certainly there's been some measure taken by the authorities that could help at a sectoral level. All this taken together, there's some base effects that should come to help as well. Could see growth numbers a bit better in the coming quarters. That should be supportive of equities, which at the end of the day, as you know, tends to be directly linked to growth dynamics.
so far, I mean, post the Indian budget, foreign institutional investors, have been pulling out money. Do you see that money coming back in a big way anytime soon, or it's going to be more staggered?
Well, I think that the definition of the budget for next year is going to be key. So long as it is, there are elements of that are going to maintain the deficit rather than widen it, or maybe some measures to actually look to tighten it, that will be a positive. My guess, though, is that we will see money coming back in from foreigners, because again, these rate cuts right and left is generating such a search for yield. Of course, that search for yield is not indiscriminate in the sense that the investors are trying to look at individual country stories to see where they place their money, and you're seeing some differentiation across countries. But so it is then therefore an opportunity for India. As I said before, at this stage, a lot of the debt issuance is basically relying on the domestic market. A very small segment is relying on foreign demand. My sense is that there's probably a lot more money that could come into India if the circumstances were right, and certainly the window for foreigners to come in, was open further.
Mm-hmm. Does oil throw a spanner in the works? Obviously, now commentary is more positive. We saw oil cooling off as well, but it really puts out, question marks now with Trump ordering more sanctions on Iran. Does the future course of oil now stand to direct what equity markets do, especially for an oil import dependent country like India?
I think it depends on ranges. So the jump that we saw on Monday this week on the back of the sad episodes in Saudi Arabia over the weekend didn't get to levels or didn't cross thresholds that I would say were very detrimental for India and certainly not for global growth. India will have a threshold of $70, give or take, beyond which you start to see a deterioration in current account balances. But we didn't get there. At the aggregate level, we actually have an estimate of somewhere around between $80 and $90 per barrel. That up to that level, it is still growth supportive for the world, because the benefit for the exporters outbalances the hit to importers. Beyond that threshold, beyond that range, however, it becomes to be detrimental to EM growth. We didn't get there. Obviously, if in the end all the announcements from the Saudi authorities do not materialize in terms of production coming back soon, we could see some reaction in markets and oil prices going back up again. But again, it'll depend how long this thing lasts and how high prices are reached. If they stay, within, at a global level, within 80, 85, I would say that there is little danger to global growth. If we go beyond that, we should start to see actually a reaction in global equity markets, because that starts to hit global growth.
All right, 80, 85 after oil has been trading around 60s is still a little steep. But moving away from that, Luis, let's talk about the currency market volatility and what the yuan has been doing and how emerging market currencies are tracking that, and what are the risk factors there?
Well, even though the Fed is cutting rates, the reality is that the dollar remains the higher yielding currency within G10, right? So ECB has cut much more, BOJ is on his way to cutting more, and we're seeing other G10 countries, be it in Scandinavia, be it in Australia, New Zealand, cutting rates as well. So the dollar remains, from that perspective, the place to be if you want to have some yield. That is going to conspire in a way against emerging market currencies. So EM central banks are going to be doing, as I said before, their easing as well. So that is going to be undermining some support for interest rate support for their own currencies. So at this stage, what we're expecting for the trade-weighted dollar is to remain rather flat. So all this appreciation that we saw of the dollar since the second quarter of last year, we're not seeing that reversing anytime soon. You mentioned the yuan. The yuan, because of this US-China trade war, the risks are for the yuan to weaken further. Obviously, there are some talks that are coming up in October. Remains to be seen what happens there. I have to say that we are skeptical, given the very far apart starting points of these negotiations, that there's a massive breakthrough that reverses the tariffs that were already adopted. But maybe there's some room for some partial agreement that at least prevents more tariffs from being slapped on each other. Our forecast, at least on paper, remains at 735 for dollar yuan for year end. So more weakness from here. This is because obviously we're not penciling in any breakthrough, any partial agreement. So that is something to watch, and that is something to maybe that could help currency markets a little bit. But we need to be patient and wait for October, see what comes out of that.
Crude 80.85, yuan 7.35. It worries me a bit, Luis. But thank you so very much. Points well taken. Appreciate you taking out the time and joining us this morning.